We provide education, consultation, ongoing support, bank research in order to be successful using the strategy. So even if you haven't got to the point that you understand all of it yet, once you understand the movement of the money, the math behind it, and see the calculator, that's when people have that light bulb moment.
This is Henry Washington, and you're listening to the Average Joe Finances Podcast.
If you're watching this on YouTube, make sure you smash the like and subscribe buttons. If you're listening to our podcast, go leave us a 5-star review. All of our links can be found in the video description or show notes below. Hey, welcome back to the Average Joe Finances Podcast. I'm your host, Mike Cavaggioni, and today's guest is David Bruce. So David, super excited to talk to you, especially about the topic we're going to talk about today. Welcome to the show.
Oh, thank you. Glad to be here.
Yeah, absolutely. Hey, first things first, I want to start this off the way I start every podcast episode, and we want to know more about you. So if you could share a little bit about yourself, share your story. You can go as in much detail as you want or share as little detail as you want. That's fine. But we want to know more about you. So if you could just tell us, who is David Bruce?
Oh, fantastic. Thank you. I am a almost 30-year veteran of the mortgage industry. I've been a mortgage broker for the majority of my professional career, and a real estate investor and an author. What I'd like to focus on is helping families be able to move forward financially, and I've dedicated my career to that. I believe in accelerated banking and what we do, to the point that I walked away from my mortgage company and focused my career from this point forward on helping people have a better way to move forward. I live in Nashville, Tennessee. Got a daughter, and an 11-year-old daughter, and a beautiful wife that we get to spend a lot of time together. I'm very fortunate that I get to work remotely. So I've been working from home for about 7 years now. So we get to do a little bit of traveling, and gives me the ability to have time to find some real estate investments and get into some other opportunities.
That's awesome. And I like the way you word that, how, you to get into some other opportunities. I also have an 11-year-old daughter, but I also have a 13-year-old daughter. So I'm going through 2 different phases right now between the two.
Oh yeah, you're in trouble.
Oh yeah, definitely.
I know I'm in trouble, so you're in double trouble.
Yes, 100%. Especially with my 13-year-old already. So yeah. Oof. Anyway, let's get all past that. So I like what you do with your accelerated banking, right? So I do the same thing. There's multiple names for it, right? Velocity banking, all different kinds of strategies of ways of using it. I personally use it to invest in real estate, right? So I really like that there's so many different ways to use this strategy and tap into your equity, right? And be able to use that for whatever your goals are, right? A lot of people, they want to focus on paying off their mortgage faster so they can have their home free and clear. Other people like me are crazy and like to invest in real estate. I'm not saying real estate investors are crazy, just me. But I think it's an awesome way to just keep that momentum going, right? And not let your money sit there, that equity sit there, right? Because when you have equity, when it's just sitting in the house, it's called equity. When you actually can touch it and use it, it's called capital, right? So that's one of the beautiful things, that you can create this capital out of your home. So I'd like to talk about that a little bit. If you can go into a little bit more detail as to what you do with this, how you help people strategize to use your accelerated banking program.
Right. So I think the most important thing to understand about accelerated banking is this is a series of advanced cash flow strategies. So basically what we want to do is we want to take control of our cash flow so that we stop giving free loans to the bank each night, so that we use our money more efficiently, and so that we can, number one, be able to minimize the interest and change the way that interest is paid all the way down to the daily level. Because once you've taken control of cash flow and you now know that you're being efficient each and every day with every single dollar in order to avoid paying unnecessary interest, now it becomes a question of what other financial goals are you looking to accomplish? because these other financial goals can be a lot more accomplishable when you have these dollars that were just being taken away from you, or you're giving away unwillingly because you didn't know that there was a better way. So by taking control of the cash flow, that then leads to the opportunity to have equity under management, where you have access to that equity, like you said, which becomes capital. You have money to invest in your retirement. You have money to set aside and invest for your children's education. You have the ability to make sure you have proper life insurance to make sure you're protected in the event of the unfortunate or the worst case scenarios. You have the down payment money for investment properties. You have access to equity for fix and flips or other types of real estate opportunities. And then all of these things lead to what I think is the ultimate goal down the road, the long-term vision of accelerated banking, which is giving people a path to be able to have a way and a vehicle to be able to create generational wealth and leave a legacy for their families.
Yeah, I absolutely love that. And that's what I'd like to gear this conversation towards is like, how does somebody, through the ways that you guys do this, how does somebody get to that point where they can start building up that generational wealth? What would you say for somebody that is just, they bought their home, let's say they've owned their home for 10 years and maybe they've invested in real estate in the past, maybe they haven't, but now they're thinking, okay, I want to start buying some real estate. What would you say to somebody like that's trying to figure that part out?
Yeah, the important part is that with the accelerated banking, again, it comes back to two things. It comes back to cash flow management, knowing your budget, and then as you're in the process. So, like you said, let's just say an example of somebody 10 years. You've owned the home for 10 years, you've paid down the balance sum, nowhere near as much as you would have hoped because of that amortization schedule in most cases. You're learning about our strategy. You're then learning how to run away from that amortized mortgage and get either a first lien position HELOC, or you're going to tap the equity through a second lien position HELOC. We also teach personal lines of credit and some other self-funding options for somebody that may not be lendable at the moment. So it's about, at that point, understanding, are you cash flow positive? Going to the calculators, seeing what type of results can be accomplished. And then it's about getting the right tool, having that line of credit that's needed, implementing the strategies. And then the goal there being is when you go through the process of getting the right tool and running away from that amortization schedule, it's about getting access to as much equity as you can. Because then once you have access to equity, that becomes opportunity, that becomes capital, like you mentioned. And now you've got down payment money. Maybe there's not enough equity to go out and pay cash for a property, but maybe there's enough money for a down payment for an investment property. Because one thing that people don't realize is that you can actually purchase an investment property with a first lien position HELOC on day one and never have to have a mortgage. So the goal is to get away from that mortgage as early in life as possible, use lines of credit to finance real estate, have access to equity, and then be able to build a portfolio for real estate. If that's what you want to do, real estate investing, be able to build a portfolio that creates new positive cash flow, new cash flow streams so that you can increase your net worth.
Yeah, I love that. So let's talk about that actually. So how would somebody like they're starting to invest in real estate and they want to just right off the bat get that first lien HELOC instead of taking out a mortgage on that investment property? How would somebody go about doing that?
The first thing that it comes down to is there's two big questions that have to be answered. Number one, can you get the right tool that you need? So can you qualify to get that first lien position HELOC? On an investment property, that's going to mean there's a 25% down payment requirement. You're going to have good credit with a 720 credit score, because honestly, not many banks are willing to do investment HELOCs. So you're going to have to qualify. You have to be able to document income. But in that case, you would just, instead of going to the mortgage and getting a pre-approval letter, which everybody has always been taught to do, is that if you're going to buy a property, you either have to pay cash or get a mortgage. Well, in this case, you would just go to the bank and say, hey, I don't want a mortgage. I know better. I would rather use the home equity line of credit, get a pre-approval letter for the purchase of the home. And then that way you can have the loan processed and underwritten in order to purchase that property from day one with the home equity line of credit. And that way you have the tool that's available to be used immediately so that you can start rolling the cash flow back through that loan in order to change the way that interest is calculated all the way down to the daily level and avoid that dreaded amortization schedule.
Yeah, I think what people a lot of times they see that lower payment up front, right? They see the mortgage payment. Oh, it's not terrible if I put this down payment and now I've got this lower mortgage payment and it's cash flowing because I'm renting it out. But what they don't see is like how much of that money, like if they're not actually paying attention to how their payment is distributed, so much of it goes into interest and very little goes into principal. And they're like, man, I've been paying off my house for 10 years, but I've only paid it down about 7%. What is going on here? Versus if you had a HELOC on the property, everything that you pay down is essentially principal balance minus the interest that you're paying, which is straight up. It's not like you're paying the interest up front, right? You're
Right.
paying that same interest on the balance of what it is. And I think that's something that a lot of people don't realize the power in that. So if you can just talk about that a little bit, what is the difference between paying a 30-year mortgage on that 30-year amortization table versus somebody paying that simple daily interest on a HELOC?
Yeah, it's absolutely huge. Again, most people have always been taught that either you pay cash for a property, if you're fortunate, which very few people can do, or you're going to get stuck with a mortgage. And then when you're stuck with that mortgage, you choose that 30-year amortization because that's what's going to give you the low payment. And then in reality, nowadays, people don't buy properties based off a purchase price anymore. They buy properties based off a payment. And that's how they use that amortization schedule against you, is they get you into that loan where you could afford the payment on a monthly payment basis. But in that first 5 to 7, 10 years of that amortization schedule, the majority of that payment is going to interest with very little going to principal. As you mentioned, you could be several years into this and realize that, oh, my balance has barely moved and I've paid all these payments. What's going on? So there's one piece of it. Another piece of it is people make the mistake of refinancing that loan because maybe they get offered a little bit lower interest rate. So they're into the loan for 5 years. The interest rate's a point lower. They refinance and start all over on 30 years all over again. So you've just reset that amortization schedule and gone back to the very beginning of that interest cycle. And then the other thing that we see happen is people don't stay in homes that long. So maybe every 7 years they move, they've barely paid down the balance. They sell the house, buy a larger home because they feel like they can afford a bigger payment. And now, again, they're starting over that 30 years all over again. So number one, we want to avoid that cycle. That's a very painful cycle that keeps people into 30-year mortgages for their entire life. It's sad to say, but we talk to people all the time that are 70 that refinanced and they got a 30-year mortgage 2 years ago. And the lenders have to give you one for fair lending laws, but it's just not in your best interest to keep doing that over and over. So what we want to do is we want to use that home equity line of credit because that allows us to now use every single dollar that we have available to deposit into that line of credit. Now we're going to make an interest payment because you're going to owe interest on what you borrow. But if I can have a smaller balance tonight, that means I'm going to have a lower interest pay or lower daily interest. So let me give you an example. Let's just say, and we see this all the time, you've got a mortgage, you're making the payments, you change to a home equity line of credit, and you've got $50,000 sitting in a savings account. That $50,000 right now, if you leave that money sitting in a savings account, there are starting to be a little bit of return on savings accounts, but not much. Basically a free loan. You're basically giving the bank a free loan each night. Where once you have, and you can't deposit, or you would not want to deposit that $50,000 against your mortgage, because if you deposit it against the mortgage as a principal payment, you can't have that money back. It's now trapped and you want liquidity. So with the home equity line of credit, you could move that $50,000 out of the savings account, deposit it into the line of credit as a principal reduction. Now tonight, your balance would be $50,000 lower. So you're not paying interest on that $50,000, which is a guaranteed return because you've avoided interest. So the heart of the strategy is interest avoidance. We want to do everything we can in order to avoid paying interest. And
Right.
I've done things that save me 17 cents of interest per day. And it makes me really happy because that was 17 cents today, tomorrow, next week, next month. And it has that cumulative effect. Little things will add up when you're only being charged simple interest and you have positive cash flow. So the goal is to get away from that amortization schedule and change the way that interest is being calculated.
Yeah, 100%, David. So you actually pointed something out and you said a word that I really love, liquidity. And the other thing that you mentioned, that's correct. If you took that $50,000 and you put it into your mortgage, right? Yeah, sure, you paid the balance, you paid that principal balance down $50,000, which is okay, cool, great. That didn't change your mortgage payment for one. For two, you can't get it back. Like you said, now if you paid it into your HELOC, you pay down that balance. One, you just lowered your payment because you lowered the interest on it. Two, if you need the $50,000, you can pull it back out. That's the beautiful part about the HELOC.
Yeah.
That's what I love about it is the actual liquidity. You know,
Right.
and there was something you had mentioned earlier too, is like the opportunities, right? So if there is an opportunity that comes up, there's this property you've been eyeballing, and now you've got the liquidity to go put that down payment and buy that rental property that you wanted, or other things, right? There's all these different things. If you want to lend money to people, that's something I've been considering doing
Yeah.
with my HELOC as well. You have those opportunities, stuff that you wouldn't have by just having your mortgage. I think that's huge.
Yeah, the liquidity really is an important piece of it. And one of the questions I like to ask people is how big of a check could you write today if you had to, or if you had the right opportunity? And would that allow you to take advantage of that opportunity, or you would be restricted from pursuing that opportunity because of a lack of liquidity? And you were right, absolutely, as far as how to use it and the ability. I had a situation during COVID where my mother had some health issues and we needed to move her. And the housing market was just absolutely crazy. So we went in and bought a house for her down the road from me to make it more convenient. And because I had enough equity in my line of credit, I could be a cash buyer. We walked in the house on a Sunday, got the offer accepted by Monday at lunchtime. I closed on Friday because I was a cash buyer. Could have never done that with a mortgage. Could have never, I probably would not have won that contract, would not have gotten that house. We turned around, got her moved. About 48 days later, we got her house sold, the house that we moved her out of. We sold it. We ended up paying 30 or 48 days worth of interest, paid the balance back down to zero. And now that money was ready to go right back to work. The other
I
thing
love
you
that.
just mentioned was lending. I also have done some deals as a hard money lender to where I turn around and work with real estate flippers and I'll help fund, they buy the property and I help fund the repairs and have a secured loan because I got a lien on the property and I'm getting an infinite return off of my HELOC because if I didn't use it, I would have got nothing.
Yeah. Yeah, that's actually something I'm in the middle of doing right now. I'm working with somebody. I might be funding their renovations on a bird project that they're working on. And because I have the liquidity, right? I have that
Right.
opportunity to tap into that equity that I have, create capital, and then deploy it. Whereas if I just had just my mortgage, I wouldn't be able to touch that. Oh yeah, I could do a cash out refinance. And now with these interest rates as high as they are, that would be pretty detrimental. And then I'd be paying a much higher mortgage payment where on my HELOC, I just pull it out and I raise the interest for the amount that I pulled out, and that's it. Yeah.
And I think the other thing about liquidity is just the fact of unforeseen situations and in emergencies. If somebody got hurt in a car accident and lost their job and went 6 months without working, went through all of their savings, got behind on the mortgage payment, the mortgage company doesn't care if you got $1 million of equity in that property. All they care about is pay me. So if you don't pay, they foreclose your house. But if you have a home equity line of credit, the line of credit can make the interest payment on the line of credit during times of challenge like that.
Yep.
So you can sleep at night. You can put your head on the pillow and not worry about it, not have that extra stress. So it also is a peace of mind and it's also a great tool to have to get through emergencies or life events.
So, David, I'm actually really glad that you brought that up because I recently went through a life event where having my HELOC was a huge lifesaver. I recently retired from the Navy, right? And that transition between getting out, getting my pay situated, to getting my pension started, to everything else that I had going on, it was, oh my goodness, where's the extra money that we need for our life going to come in from? And I'm like, oh yeah, I've got a lot of equity still right here on this HELOC. I've got a lot of stuff I could tap into. We're good. And during that whole transition process, I was able to utilize some of the equity in my home to sustain our life while I was transitioning out of the military, which is absolutely amazing. Where a lot of people get stuck in a situation and they can't do that. They'll be transitioning out and be like, man, I might lose my house. I'm very thankful that I discovered this strategy a while back. And that's why I really enjoy having you on to share your story and share the strategy again, because I think, two other episodes on this show talking about this with other people that do the same thing. So I'm always excited to have another person on to talk about this because I do feel like it is it's not as out there as I think it should be, right? There's not a lot of people that really know about accelerated or velocity banking, right? And so if I can provide that education by having somebody on that can talk about this, I'm always willing to do that because I feel like the more educated somebody is, the better decisions they can make. And I think a lot of people find that this strategy would be really good for their specific situation as well. And actually,
Right.
speaking of that, now you've had plenty of experiences with people, that have come to you and they're quote unquote trapped in their mortgage and trying to figure out the best way to move forward. What would you say is probably one of the best success stories you've heard of somebody that's came to you and asked for help with this?
Oh my goodness, I've got so many that I could share. One that comes to mind is we see whenever we do this and we go through the calculations. So, little background on this. In order to determine what somebody's going to be able to accomplish on this, we need to understand how big is your mortgage, what other debts do you have, what are your monthly expenses, and then what's your income. Because this is cash flow. It's about every dollar that comes in and then in every dollar that goes out. The gentleman that comes to top of mind is someone that we had come in and spoke with our enrollment team recently, sharing his experience. And he came through, was able to have a very short payoff because he had a bunch of debts. He had some kids that he had to get through college. And so he refinanced his mortgage into it, ran away from the mortgage, got into a first lien HELOC, had a lot of equity in the home, paid off like 3 cars, which had like almost $2,400, $2,500 worth of monthly payments on the cars, paid
Wow.
off some credit card debt, had access to equity. And then he was going to be able to use that equity to help send his kids to college so that they don't have to get student loans. And because his cash flow was so strong, and because we created new cash flow by consolidating all of that debt, he had a payoff of less than 5 years. So he came in and shared his story with us a few weeks ago, and just over the moon on what this is going to allow him to do. He's now looking at doing some real estate investing and being able to start building a portfolio to create some new income streams. Just one I've seen. I paid my home off in 13 months using the strategy. We see people with everybody's payoff is going to be slightly different because the balance is the enemy. And the larger the balance, obviously, the bigger challenge it's going to take. But there's so many different stories of people. And then there's also a lot of nightmares that I could tell you from people that try to do things on their own and don't understand it and don't get the proper education and don't get the right loan and don't understand how to move money properly. And then they come in and tell us, I did this because I saw some videos and I took it upon myself and something's wrong. I can't figure this out. Why isn't this working? And then unfortunately, we do a deep dive and realize who told you should do this in the first place? Nobody. You took it upon yourself without educating yourself. Unfortunately, Mike, not everybody should do this. If
Right.
somebody's living paycheck to paycheck, or there's very little cash flow left over each month, and it's a large balance, this is a math problem. And sometimes the math just doesn't work. It's not for everybody, unfortunately. I wish I could say it was.
Yeah, no, it 100% is a math problem, but and it has to be one that when you solve it, it's positive, not negative.
Right.
But I'm glad you mentioned that because that was almost me. I was actually in the middle of taking out a HELOC and I was supposed to sign the paperwork literally the day I was hopping on a plane to go to a real estate conference in Phoenix. And when I was at that conference is actually when I ran into somebody that I'm working with, similar to what you do, right? I ran into them and I sat in their seminar. And as I watched it, I'm like, okay, so I was actually taking out the HELOC to buy more real estate, right? But when I listened to their presentation and everything and learn more about it, talk with them a little bit more offline, I said, hey, so I actually just got approved for my HELOC and I'm actually going to sign the paperwork as soon as I get back. I was supposed to sign it the day I flew out here, but I'm really glad I got to hear your presentation and I want to learn more. And by doing that, I probably saved myself a lot of angst and future problems because I was going to go in and just tap out all my equity and dump it into all these real estate projects that I wanted to get into. And I would have completely lost my liquidity. And one of the things I found by doing it this way, that I used half of that to invest in real estate. The other half I had for chunking down and like building up more liquidity and consolidating some other debt and things like that. And it completely changed the way I looked at it. And I said, okay, by doing it this way, the math works and this is working out great. I think that's very important. So, like you said, it's not for everybody. However, if you are cash flow positive every month, this can be a very strategic way to either pay off your home faster or get into more real estate faster as well, because you get to increase your liquidity. And by increasing your liquidity, you increase your access to funds, which is absolutely awesome. Yeah.
And from what you've described, I'm glad to hear that you had that moment before you just went crazy.
Yeah.
Because
Right.
you don't want to do that. But it also comes down to what you did basically was you turned your house into a bank. So it's
Exactly.
now the bank of
Yep.
Mike's bank.
Yep. And
And now
that's what
you
I try to
can,
describe it to everybody too. When people
yeah,
ask, I'm like, I basically turn my home into my checking account, right? And I just replenish that balance every time I get paid a distribution from one of my real estate investments, every time I get paid my pension or anything else, like from my other businesses, every time I get a payment, I put it right back into the HELOC balance as soon as I get it and pay that balance down. Why? Because every time I pay that balance down, my interest payment is now going down as well. And then whenever I need to pay for something, I have my cell phone bill or something else comes up that I got to pay for. What do? I pull it out of the HELOC, put it into my account and pay it. So I essentially turn my house into my checking account, which is absolutely awesome. I
it's a
love that.
powerful feeling. I
Yeah.
will tell you, once you get this up and running and you see the results are going to be there for you, you get the tool, you're implementing the strategy. When you put your head on the pillow at night, you know that, hey, you know what? I'm going to owe some interest because I have a balance, but I'm not going to owe any more than I know I can because I'm going to do everything I can to get that balance as low as I can each night. I'm going to pay what I owe, but I'm not going to give the bank a tip each month. That's my
Right.
money.
Yep.
I'm fighting for it. I'm not going to let you have it.
Yeah. No, I
It's
love
a
that.
wonderful feeling when you put your head on the pillow each night.
David, help me out here. So I've had a few people ask me, and I cannot explain it as eloquently as maybe you can, or the people that I've worked with for this, right? Because they're always like, "Hey, how does the math add up?" and this and that. And I said, "Look, I'm not." Even though like I have a podcast talking about finances, right? I'm not the biggest math person. I try to find the right people and get the right people involved. And that's one of the things that's always worked for me. And thankfully, I found the right people. But how do you explain this to someone that's like on the fence and they're like, I'm not too sure if this is the right strategy for me, but they are cash flow positive and you know that this would be a really good move for them? How do I tell somebody like, hey, this is really something you should consider, and explain it to them in a way that they'll understand?
Yeah, really the way that we do that is we provide a free consultation in order to help someone evaluate their situation and see, number one, because again, there's two big questions we have to answer. Can you get the right tool? Because that's going to be needed to use the strategy. And number two, are you cash flow positive enough that there's going to be the results that you would be looking for, that this is something that you should even consider? We do this by invitation only because we probably turn away probably close to half of the people we talk to because they're just not quite ready. And this would not be the right fit for them at the time. So what we do is we go through the numbers and we take it and we show the calculator. And our calculator breaks down the math. It shows how the different strategies that we use, we can show the math. And what I have found is that sometimes, even if you don't understand the full how everything moves, because that's what we teach. We provide education, consultation, ongoing support, bank research in order to be successful using the strategy. So even if you haven't got to the point that you understand all of it yet, once you understand the movement of the money, the math behind it, and see the calculator, that's when people have that light bulb moment and say, oh, okay, I get it. I'm going to go from 27 years and with a total interest percentage of 62% down to 7 years with a total interest percentage of 23%. And what I'm telling you there with that total interest percentage is the secret that nobody wants you to pay attention to in mortgage finance. And that is the total interest percentage is what's known as the tip. And it is disclosed in all mortgage related activities now. It used to be not disclosed because you've got the rate and you've got the APR, and people know to look at APR as a yardstick, but they don't know to pay attention to the tip. The tip is the total interest percentage over the life of the loan that you're going to pay in relation to what you borrowed. So if you borrow $400,000 and at these current interest rates of even at 5.625, which is the last one I did the calculation on, it's a tip of 119%. So you're going to pay over 400, you're going to borrow 400,000 and pay over 400,000 back over the life of that loan. That's the number we need everybody paying attention to. And once we can show the math and you can see that you're going to do several things. One is you're going to pay off faster. Number two, you're going to pay off less interest along the way. Number three, you're going to pay a smaller tip percentage over the life of the loan. And number four, the other thing that people don't realize is that every time you avoid interest, you actually reduce your effective interest rate. So even people that are borrowing money at these 6.5% rates right now, if they use our strategy, they may be able to cut that down by 30, 40, 50% and actually have an effective rate in the threes because they're using the strategy and not just letting the amortization schedule ride. So once people understand the math, that's when the conversation really starts as to, okay, then the question becomes is, are we using the right numbers? Is this the right income? Are these the right expenses? Do you feel confident with these numbers? And that way we can set expectations properly. And then if the results are there, we invite them into our program and provide the coaching and mentoring service.
All right. No, that's fantastic. Thank you. Because I feel like that's the biggest thing is you got to show people. And like for me, like when I first looked at this, I think that's the thing that actually caught my attention when I was watching the presentation and I actually saw the numbers. And you look at the lifetime of a fully amortized mortgage versus 5 to 7 years of paying a home down with a HELOC. And you look at that total interest paid and you're like, wow. You look at the amount of money that you would spend on that 30-year mortgage versus what you would spend doing it with a HELOC, and it's just mind blowing, right?
Yeah.
What you could have put that money into, right? If this, like you said, that $400,000 loan, where you're really actually paying about 840,000 plus, right, on the back end of that. What could you have done with that 440,000? Realistically, you're still going to pay some interest, but after that, let's say you probably would still have at least 300,000 that you would have saved. Right. What could you have done with that $300,000? You could have bought more real estate. You could have made that money work for you. And I think that's the biggest thing that people need to see.
It's the time value of what that money can do for you when you didn't let the bank have it.
Yeah. Love that. Yeah. 100%. It's the time value. As a matter of fact, I just did another interview not too long ago. And that was one of the biggest things we talked about was the value of your time. And I think that's huge. Okay, David, I want to transition this into something that I call the final round. It's where I'm going to ask you the same 4 questions I ask everybody that comes on this show. And we're going to see like where your head's at when you're asked some questions a little bit under pressure. So if you're ready to go, we'll get that party started. All right, let's do it. All right. Hey, the first question would be, and especially since you were in the mortgage space and now in this space with the accelerated banking, I'd like to ask you, what's the biggest mistake you've ever made in finances?
I think the biggest mistake it comes to this strategy, actually. I learned about this strategy back in 2006 when this was brought to the United States by an Australian bank. And then with 2008 and 2009, mortgage companies started failing. The bank turned around and went back to Australia, and it was over. I was really excited about this being the future of finance, mortgage finance. And I'm like, we tried to recreate it and we did for a little while. And then the lenders that we had recreated it with went out of business and they failed. And then I just said, that's over. Come to find out about 10 years later, it wasn't over. It was just sitting on the shelf, not being talked about. So when I found out that I didn't know that, and at the time I owned a mortgage company, that I did not know that it was still available sitting on a shelf, I was absolutely livid with myself. How in the hell could I not know? And so that just the number of families that I could have helped during that period of time. And when I found out about that again, that's when I rededicated myself, that I knew within 1 minute of knowing it was available. Okay, I just changed gears. I'm back. This is what I'm doing. Because I was doing mortgages. I've been a mortgage broker.
That's awesome. You know, it's really funny that you had mentioned how back in 2006, the person that brought this strategy over here was an Australian banker, right? Because another name for this strategy is called the Australian mortgage, right? Because this is how it works in Australia, right? You actually buy the home that way and you pay it down with simple interest. And it's basically a first lien HELOC. So that's absolutely awesome.
Yes.
I had no idea.
That's one thing that people
that's where
don't
it came
realize.
from.
Yeah, one thing that people don't realize is this is very common in other countries.
Yeah.
Australia, New Zealand, United Kingdom, a lot of other countries have done this, but to be perfectly honest, the banks here in America are interested in getting you in debt and keeping you in debt, and they don't want to give up that free loan you give them every night by letting your money sit in their checking account.
True.
That's the reality.
Yeah, no, and it's the harsh reality that we face too, because the longer that you stay in debt and have a mortgage, the longer you are a customer to them, paying their bills and paying their debts.
because
All
then
right.
you need car loans and credit cards and all the
Yep.
other things they sell you as well. And next thing you know, you got all these debt payments where you could have one, which is your line of credit.
Yeah, and it's funny. You mentioned something else, and I totally wanted to bring this up when you said it about how the mortgage companies now they sell you the monthly payment. That people focus more now on the monthly payment versus the price of the home. And this was the same thing I remember when I was a very young man that I was always told that do not focus when you go to the car dealership. Do not focus on the monthly payment. Who cares about what they tell you the monthly payment's going to be? Focus on that back end price because that's what you're paying for the vehicle. Don't let them rope you in with the monthly payment thing. So I just wanted to add that in there because
Yeah.
it just makes so much more sense that it's the same thing as happening in the real estate market right now.
Yeah.
You know,
It's absolutely the evolution from car finance, like you just meant, because that's how they sell cars. You can $500 payment, you can have car A or car B. Okay, great. I'll take car A. Now it's evolved into mortgages because people don't want to focus on, oh my gosh, that's a $500,000 house. Oh, it's a $500,000 house you could have for $2,700 a month. Oh, I can handle $2,700 a month. Okay, I'll take it. Yeah, it's the wrong
right.
yardstick.
Yep. Yeah, absolutely. You're looking at the wrong thing. You have the wrong target set in your sights. So awesome. Okay. So the next question kind of ties into that last one. And that is you've learned a lot throughout your time, both owning a mortgage company and now doing this strategy. So, what is something that you've learned that you wish you would have known when you first got started?
I think the main thing that I wish I had have known was that there was a better way and that I could have where I could be moved, where I could be financially had I known better. So the way that I look at it is it's not just what I wish I had have known, but it's what I want everybody for the younger generations to know is the mortgage is not the way to finance real estate. And if you do need a mortgage to buy the house, make sure you run away from it as fast as you can. It can be a good stepping stone, but don't just do it over and over. So one of the big mistakes that I made and wish I had have known was not to chase the interest rate because the mortgage industry teaches you to chase the rate and the interest rate is not the enemy. It's balance and time that are the enemy. I wish I had have known that a long time ago.
Yeah, no, I really like that. 'Cause I think it's funny because when I got my HELOC, I had the choice of a 3-year locked in at 3.25 or a 5-year locked in at 4. And I chose the 5-year locked in at 4 because it gave me that longer time locked in at that rate. And for what I was using it for, the real estate investments that I was in are like 3 to 5 year holds. And I said, okay, in a worst case scenario, and I'm not able to pay this off before that time period, I know I'm going to get my capital back and then I could pay it off.
Yeah.
That's the way I was looking at it. I was like, okay, I can hold this a lot longer at a little bit higher of an interest rate. And there was also what I had to do to convince my wife to be more comfortable with it as well. But it worked out. So I think that's the thing too. Just you don't chase that interest rate.
Right.
Chase the balance, chase the price of the asset that you're picking up or the home that you're buying, whatever it is. It's the price that matters, not so much the interest rate.
Right. Interest rate only dictates payment. And that's the
Right.
thing is people have been talked into refinancing. Most everybody that probably watches this that's refinanced, if you went back and looked at your numbers, you might come to second guess yourself that it may have been better not to refinance in some cases. The industry has taught people to do that because it churns the loans, gives them another origination, gives them another commission, when it's not necessarily always in the best interest. Now, there are strategic refinances and where rate can be important, but as the majority of them, to lower the rate and pay closing costs and start over to save $100 a month is not always a victory.
Right, 100%. Yeah, because now you're looking at 3 to 5 years to pay off that fee that you paid just to refinance.
Yeah.
So that's huge. Okay, next question of the final round is, do you have any tips or tricks that you would recommend to someone that is just getting started out today? Like let's say somebody that is just starting to look at this strategy in particular.
The number one tip is budget. If you don't know where your money's going, you're just spending freely, be able to do something and get ahead, but you're limiting your options. You're limiting your opportunity. So first thing is always budget. Come up with a reasonable budget. Try to stick to it. And it's one thing to say I have a budget. It's another thing to reconcile a budget and see where you actually came in at the end of each month. Because I see people all the time that, oh yeah, I have a budget. Okay. How did you do on certain categories last month? What do you mean? Were you on budget, over, under? How about you budgeted $500 for eating out and entertainment? How did that go? Did you spend more or less? I don't know. Well, you're not budgeting.
Those
It's
are
a
the
matter
questions.
of not just budget, but reconcile.
Yeah, I feel like those are the questions we need to ask the government.
Yeah, no doubt. They
when,
definitely don't know what
when
that
it
means.
comes to their budget, right?
Yeah.
It,
Reckon
it's
what?
what's reconcile mean?
Yeah,
No, that's funny.
exactly.
I don't want to get into politics or anything, but I'm just
Yeah.
saying it's just funny when you think about that. Balancing a checkbook is basic. That's 101. And when it comes to your budget or your spending plan, you need to know what you have in excess at the end of the month, right? You need to know what's left over. You can't just kind of wing it. And a lot of people live that way. I used to live that way for the longest time, right? And then once I figured it out, I was like, oh my goodness, it was like the light bulb went off and my life completely changed, right? Anyway, that's it for those kind of questions. I have one more question in the final round. It's an opinion-based question. And I will preface this with besides your own, because we'll get to this in a second. But do you have a favorite business, investing, or real estate related book or podcast or both?
I tell you, the one that something that I've read recently that really is sticking with me is Extreme Ownership. And it's by Jocko Willink and Leif Babin. They are Navy SEALs that use their experience as Navy SEALs for leadership. And you can't lead others if you don't lead yourself. And if you aren't willing to have extreme ownership to yourself, how can you have extreme ownership to anyone else? So it's all about being able to be willing, which is a big thing, to be willing to be responsible and accept responsibility for your decisions and your actions and learn from the good ones and learn from the bad ones in order to be able to gain wisdom to not repeat bad decisions and to be able to repeat the process of how to make a good decision. So
Yeah,
that really stuck with
100%.
me. And I'm using it personally in my life. I'm using it in our team, in our organization, as we work with our enrollment team, when we work with our client success team. We're just making sure that everybody throughout has that extreme ownership to themselves. And it's really important for the strategy, because at the end of the day, it's how you use that line of credit that's going to determine the results. And if people go out and say, I paid my balance down 40,000 last year, I think there's time for I need a bass boat. And next year I paid down another 40,000, and this year I need a new car. And they keep just stepping on their progress and taking a step backwards. So there's things you want to live. You want to live your lifestyle, you want to do your
Right
things,
there.
but it's about not blaming somebody else if you do those things and wondering why you're not getting the results that you thought you were going to get, or you're not 5 years from now, 10 years from now, you're not where you want to be. You have to look in the mirror and say, it's me. It's
I'm the
me.
problem. Yeah.
Yeah.
I think Taylor Swift has a song about that, right? I'm not
Sometimes,
sure.
yeah.
My
You're
kids
either
would
the
know.
problem or the solution. It depends. Yeah.
Yeah, 100%. Yeah, that's the type of extreme ownership that people need to have. So that's definitely a great book recommendation. I definitely appreciate that. Speaking of book recommendations, I know that you co-authored a really great book specifically about this type of strategy and being your own bank. So can you share that with us? What's the name of the book and who'd you co-author it
Sure.
with? Where can people find it?
Yeah. The name of the book is Break Free from Your Mortgage. And I wrote that with my partner, Sam Kwok, the Kwok brothers. And you can get a free copy of that on our website. So I want to give you a site here that you can go visit. And this is going to give you access to a couple of things. One, so the website is acceleratedbanking.com. Very simple. And at that site, you can register to get a copy of our calculator so that you can see the math. Once you've done that, you'll have access to be able to download our book. It'll be an ebook, or you can even request for $5, you can request a physical copy to be mailed to you. And then that's going to open up some other materials, education materials that we offer, as far as a webinar that's going to talk about what the strategy entails and how some of the benefits and how you can accomplish through using the strategy. And then from there, we also lead to a free consultation to where once you've gone through your budget and kind of pre-educated yourself, figured out what questions you're trying to answer for yourself, we then do a free consultation in order to help you evaluate potential results and qualification and help you move forward financially.
Awesome. I love that. Thank you so much. Do you also have any social media that anybody can follow? I got your website.
Sure. Yeah, we're on social media. It's just Accelerated Banking across the platforms. We try to keep it consistent.
Awesome. Hey, so I will make sure I have links to your website, to all your social media profiles and all that in the show notes to make it easier for our listeners to find you guys. And also to my listeners, don't go and copy and paste it while you're driving. Save it for later, but it'll be easier for you guys. You can copy, paste, or click away and check out what David's working on here with the Kwok brothers. I've seen a bunch of their stuff on YouTube, and I've actually been to the website. I'm pretty sure I actually have the PDF of your book. It's great stuff. So I really appreciate you sharing that with all of us. And David, again, thank you so much for coming on the show, sharing what you do. It was so much great information. I think my listeners are going to get a lot of value out of it.
I appreciate you having me. And our mission is to just help families and here have a financial peace of mind and have a chance to break that cycle of being taken advantage of by the banks. And our mission is to help these families on their path to debt-free home ownership and wealth creation.
Yeah, absolutely love that. So again, thank you so much. And hey, to my listeners, thank all of you so much for joining me and our special guest, David Bruce, on the Average Joe Finances podcast. Go leave us a 5-star review and tell us what you liked about today's episode with David. Aloha from Hawaii and have a great rest of your day. Thank you for making it to the end of this episode. Greatly appreciate you being here with me today on the Average Joe Finances podcast. If you haven't done so yet, make this the episode that you go leave us a 5-star rating or subscribe to our YouTube channel. The Average Joe Finances podcast is for informational and entertainment purposes only. Have an outstanding day.